Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to remeasurement, consolidated net income, and stockholders' equity. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to follow along in OneNote, but if you have access and you would like to, we're going to be in the 1228. It's going to be the remeasurement, consolidated net income, and stockholders' equity. We're in the tab problem presentations. We're going to go over the information that will be involved in the problem. We'll go over all of the information first, then we'll pull pieces of that information as we work through the problem. So we're talking about the remeasurement, journal entries, consolidated net income, and stockholders' equity. A lot going on here. Let's get into it. January 1st, 2000 X4. P, the parent company, acquired all the outstanding stock of S, which is going to be the subsidiary, which is a Norwegian company. So it's going to have a foreign currency component that we will have to be dealing with. The cost of it then for P to purchase the outstanding common stock was $155,000. That's in dollars. Dollars are going to be represented with a dollar sign, foreign currency with the NOK. And then S, the subsidiary's net assets at that point in time, assets minus liabilities, or the equity section at that point in time, was $700,000 of the foreign currency. Then the book and fair values of the subsidiary are the same, except for, this is going to be the differential that we'll have to take a look at. The property, plant, and equipment is greater by the $20,000, so we'll have to deal with that. It's in dollars though, so we don't need an exchange process to do so. The remaining life is going to be 10 years. The remainder of the differential is not going to be going to goodwill, but rather to another intangible asset, that intangible asset being a patent. It will have a 5-year useful life, so we'll have to be dealing with both depreciation of the property, plant, and equipment and amortization of the intangible asset of the patent. S, or the subsidiary, uses first in, first out inventory method. Beginning inventory was purchased on 12/31/X3. Ending inventory was purchased on 12/15/X4. Now remember, we're going to be doing the consolidation at the end of 2000 X4, so the purchase of the parent company, of the subsidiary by the parent company, happened at the beginning of 2000 X4. We're going to be then consolidating at the end of 2000 X4. Then the purchases in 2000 X4 were $430,000. This is for inventory of the foreign currency. And then S purchased all property, plant, and equipment on July 1st, 2000 X2. So notice that's before the time period that parent company purchased the subsidiary, which happened in January 1st, 2000 X4. So the property, plant, and equipment, in other words, was purchased before the date that the parent company purchased the subsidiary. Straight line depreciation is what's going to be used. S sales and expenses are incurred evenly throughout the year. So the assumption is that the sales and expenses are incurred evenly. On 7/1/X4, dividends were declared. So 7/1/X4, that's when the dividends are going to be declared. Then we're going to get some information for the P company, which is the parent company. That's going to include the income from its operations in dollars. So these are going to be more straightforward numbers because they're in dollars. We don't have to think about, the conversion process. We're concentrating on the subsidiary because the subsidiary does have the conversion problem process that we'll have to be dealing with. So the P income, parent company, from operations, $237,000. The stockholders' equity, $3,600,000. Dividends are going to be $130,000, all in dollars. Relevant exchange rates will be here for the relevant dates, comparing the foreign currency to the related dollar for the exchange. U.S. dollar is the functional currency. This is a key point here. We have a subsidiary in a foreign country. And you would think then that they might be using the foreign currency as their functional currency unless they're going to be kind of more related to, we went over the rules on what's the functional currency in a prior presentation. But in essence, if they're more kind of tied to the parent company, which is a U.S. company in our example here, then the functional currency may be the U.S. dollar, right? So, and that's the case here. So even though they're in a foreign country, even though they're conducting their books in the foreign currency, we have determined, based on our analysis, and you can see what the analysis is on what a functional currency should be for a company and looking at prior presentations, we've determined that the US dollar is actually the functional currency that should be used. So that makes a difference in terms of how we're going to convert this thing. We're in the same situation as if, the functional currency was the foreign currency. We'd still have to get it to the US dollar at some point so that we could do the consolidation with the parent company, which is in the US dollar. But the process is a little bit different because it's not going to be a translation in this case. We're going to do a remeasurement. So this is a remeasurement. Why? Because again, it's a foreign currency. We gotta take it and exchange it, or we gotta change it to the US dollar. But it's not a translation in the terms that we have seen before. It's a remeasurement, which is slightly different. So we got make a schedule remeasuring trial balance from the kroner, which is going to be the foreign currency, which I'm going to forget all the time, and I'm just going to call foreign currency from here forward, to the US dollar. So here we have it. Here's going to be our first worksheet. This is going to be basically the trial balance that's going to be in the foreign currency that we're then going to remeasure to the US dollar. We're going to remeasure. So I've kind of blanked out the rates over here and the ending trial balance. So this is going to be our beginning trial balance. This is for the subsidiary, and the subsidiary is in the foreign currency, but the US dollar, and that's indicated by this NOK up top. I'm not going to put it on every line here. So just note this line is in foreign currency, which we're going to have to remeasure rather than translate to the US dollar. If I say translate by accident at some point, just remind yourself we're talking about remeasure here as opposed to the translate. So it's going to be a different process. That's the point. So we have here then the trial balance. We've got the balance sheet. It's going to be in green. We've got the orange is going to be the liabilities. The green are the assets, orange are the liabilities, both balance sheet accounts. And then we have the blue, the light blue, equity section, dark blue, income statement, net income in the foreign currency. This 164,000 revenue minus the expenses down below. We see that we are in balance in that the debits minus the credits equals 0. Therefore, we are in balance. Now, when we think about this, it would be the easiest thing to do if we were going to remeasure this thing to the US dollars using some type of exchange rate. It would be nice if we could just pick one relevant exchange rate and just use that the whole way through, because if we could, then we would end up with something that would be in balance, because we're starting with something in balance, and if we were multiplying it all by the same thing, then the ending number would be in balance. However, we cannot do that because, again, if we think about this, if you just think about this and say, well, what type of exchange rate would we use to do that? You would say, well, balance sheet accounts, maybe we should be using, that's as of a point in time, that's as of the end of the year, so maybe we should be using then the exchange date at the end of the year. That would make sense. But maybe we have some items like you might say, well, property, plant, and equipment, what if maybe that should be done when the purchase took place? Maybe we should use a historical cost, possibly. And it could differ whether we do a translation or a remeasurement. I'm just kind of throwing different ideas on why we might use different rates. And then on the income statement side, we might be saying, hey, on the income statement, we should probably be using, we shouldn't be using the rate at the end of the time period, because the income statement represents a beginning to the end, a whole time, like the whole year of activity is happening there. So we should be trying to pick a rate that's representative of the whole year somehow, some kind of average or median or something like that. So the income statement we would think would be different for sure. And if we had some kind of large item that happened on the income statement, then like say depreciation's like related to the property, plant, and equipment. So maybe we should be using a historical rate in that case or something like that. Or if there's some really large purchase or large thing that happened that's affecting the income statement, maybe not a purchase, but some large activity happened on the income statement, maybe we should be using like the rate at the point in time that happened. And then if you think about the dividends, you might say, well, the dividends, we know that they happened like on one specific date. There's not like dividends that are happening every day throughout the year. So we should just pick that date. Why don't we just pick that date and do the translation then? That's what we should kind of do. And then the retained earnings is kind of complicated because it includes the beginning balance from last year, and then the net income rolls into it, which we would think we'd use like an average rate. And then the dividends go into it, which kind of you would think we would use the rate for the dividends involved in that one. And then the ending retained earnings is part of the balance sheet. So maybe we should be using the balance sheet like ending date rate for that one. So you can see that we have a problem with deciding what rate we're going to use, and we're going to use different rates at the end of the day. And that means that the ending balance will not be in balance, and we're going to have to do some kind of translation adjustment. Now, because it's a remeasurement, we're going to put that adjustment right in the income statement, just simply calling it a remeasurement gain, or in this case, loss, right? We're going to say it's a remeasurement loss, but we're not putting it into comprehensive income or other comprehensive income. Okay, so let's just take a look at some of these rates that we will then be using. So we'll scroll back up and say, all right, let's take a look at some of these rates. So we're going to go up here. I'm going to say on the balance sheet, we're going to start off with the ending rate, which is 0.21, and that's going to be the rate at the end of the year. Now I've kind of color coded this now. So we're using this rate for the balance sheet, which kind of makes sense for most balance sheet accounts. We're going to deviate from this like a lot, but the general rule on the balance sheet, we're going to say, hey, the balance sheet is as of the end of the year. It is what it is as of that point in time, that 12/31 end of year, that date. So we should be using the exchange rate for that date for, like, most of that should be like the default. So if we take this 164 times that rate, 0.121, we get the dollars. Now we're in dollars of the 34,440. That's the remeasurement. We're remeasuring, not translating. We have the accounts receivable. We're going to use the same rate, same logic. Then we've got the inventory. The inventory, we're going to use a different rate because we're purchasing something, and we're going to say that it told us in the problem that the inventory that's in ending inventory, we happen to know it was all purchased on 12/15. So now we have something on the books that we know, when it was purchased, and it's sitting on the books there. It's not like a receivable or cash. So we're going to use the date that we purchased it, more of a historical date at this time, which is going to be, now we're going to use that rate, which happens to be on 12/15, which was 0.205. So we're going to be using the 0.205 there. So we're going to have the 281,000 times the 0.205 gives us the 57,605 in the currency. Then we got the property, plant, and equipment. We're going to use the similar logic there. We're going to say, hey, the property, plants, and equipment, we don't purchase a lot of property, plants, and equipment, so maybe we can pick those out, and those are large purchases, and just figure out when the purchase happened and use the historical rate, which is what we would do basically. But we know that the purchase of the subsidiary took place at the beginning of the year, and that's kind of like a market transaction in and of itself. So the purchase of the property, plants, and equipment happened for the subsidiary prior. All the property, plants, and equipment was purchased prior to the parent purchasing the subsidiary. Therefore, we're going to use the date that the parent purchased the subsidiary, which was on 11x4. So we're using 11x4. That's going to be the 0.18. So the 0.18 for the property, plant, and equipment. Same logic for the accumulated depreciation. Obviously, we're taking these numbers, multiplying them times the rate to get to the dollar amount at the end of the day. Then we have the accounts payable. We're going to go back to the same logic we did for the cash and use the ending date. So we're using that ending date, the 12/31 date, and we're going to do that for the notes payable as well, using that 12/31 date, multiplying these out to get the dollar amount. Then we have the equity section, common stock, and let's do the common stock and the retained earnings. Now these two, no more common stock was issued after, the parent company purchased the subsidiary at the beginning of the year. Nothing else happened with the common stock since that point in time. So we're going to use the 0.18, which is the beginning of the year when the purchase took place. And then the retained earnings is going to be something that, this is the beginning retained earnings on a trial balance, because the temporary accounts have not been closed out to it yet. So in other words, net income is not yet included in retained earnings. Dividends are not included in retained earnings. This is beginning retained earnings. Nothing else is included throughout the year. So we would be using the beginning retained earnings rate, which would be the end of last year, the beginning of this year. We're going to use when the parent purchased, again, at the beginning of the year, which is going to be the 0.18 once again. Then the dividends went out, and we know the date that the dividends went out, because the dividends aren't happening all the time throughout the whole year. We can basically just pick the date, use the exchange rate when the dividends went out. It was told to us somewhere up here. They told us when the dividends went out somewhere up here. right here, it says on 7/1 X4, that's when the dividends were declared, and I'm assuming went out. So that's going to be the 0.19. So we're using the 0.19 exchange rate, the one on 7/1 for the dividends. So the 52,000 times that 0.19, that's going to be the 9,880. Then we're on the income statement. So with the income statement, the general rule then you would think would be, well, now we're talking about something like sales happened from January to December, like the whole time, like there's sales every day that are happening. So we should be using some rate that's kind of like an average or some kind of representative rate, which you would think would be an average. And that's what we'll use here. We're going to say, all right, now we're going to use an average rate. So we'll average the rate. So that's going to be the 0.2 that we're going to use. So 0.2 on the revenue. And then the cost of goods sold, we're going to do something a little bit tricky down here. We're actually going to do the calculation, a separate calculation, and we'll see that shortly. So we'll come back to this number. That's why it's red. We'll come back to that later because we're going to do the cost of goods sold calculation, which is beginning inventory plus purchases equals available for sale minus ending inventory. And then we're going to use different rates for those components, which is going to be great. So we'll see that. We'll see that soon. And then we have the operating expenses, which is the same logic we had for the sales up here. We're going to be using that average rate of 0.2. And then we have the depreciation. Now the depreciation, since it's linked to the property, plant, and equipment, and we use the beginning rate for the property, plant, and equipment because the equipment was actually purchased before the parent company purchased the subsidiary. So we use the date that the parent company purchased the subsidiary, which was at the beginning of the year, January 1st, 2000 X4. We're going to do the same for then the depreciation. And then that's it. But now then, because now we used all these different rates, so now our ending balance, if we were to add up our debits and credits and add them up, they wouldn't match anymore. Like the debits and credits don't match anymore. And they would be off they are off if you were to add them up. All these debits and credits, I won't do it here. It's kind of tedious, but just trust me. You can do it, though. You don't have to trust me and do it, but I'm not going to do it here. But if you do it, then you're going to be off by the 1,450, and that then we're going to have to adjust here and we're going to call it a remeasurement loss. Remeasurement loss is what we need to put us back in balance, and we're just going to tell the reader that. We're going to say, hey, look, we used all these exchange rates to not translate, to remeasure from the foreign currency to the dollar, and we had to use these different rates because we thought these were the best rates, or that's the rates they told us to use with the regulations. And that, of course, resulted in this remeasurement loss, which we're just going to include on the income statement and tell you, hey, this is the remeasurement loss that's going to be included. It is included in the net income now. So now when I look at the net income, sales minus cost of goods sold, operating expenses, depreciation, and the remeasurement is where we're going to get that 39,315. In other words, it's not going into other comprehensive income as it may if we were doing a translation as opposed to a remeasurement, which we're doing here because it's a remeasurement because the U.S. dollar in this case happens to be the U.S. dollar is the functional currency as opposed to the foreign currency being the functional currency. So now let's do the calculation for the 78,075, the cost of goods sold. So how are we going to get that red number there, that cost of goods sold? So we're going to do the cost of goods sold calculation. We're going to calculate it in the foreign currency, and then we'll use our translations to the rates of the components of the cost of goods sold calculation that we think are applicable. So we're going to take the beginning inventory number, which is the 276,000. Now we're actually going to back into this number because we know all the other numbers except for the beginning inventory. But when I think about the cost of goods sold formula, I don't like to write it in a different order because people start to think that they got to remember like 5 different formulas in order to know how to calculate for beginning inventory and ending inventory and purchases and whatnot. But I would rather just keep on writing it in the cost of goods sold formula. So think of this as the plug that we're going to go back to, and we'll figure that out. What we do know at this point in time is that the purchases are 430,000. They gave us that number. So the 430,000 was given to us somewhere up here. Oh, I have it over here. So here it is. So the purchases were right here for 2000 X4 and foreign dollars 430,000. So that was given to us. Then we're going to multiply times the 0.2, because the 430,000 happen throughout the time period, and therefore we're using the average rate, which is going to be the 0.2. Okay. Then we're going to get to the, the cost of goods available for sale. Again, we kind of back into this number because I'm assuming we don't have this first one yet. But if we did have it, then we would add these together. So we'll kind of get back to this number and calculate it. What they gave us is the ending inventory. We know the ending inventory. So the ending inventory is on the trial balance. So in foreign currency, it's going to be the at 281,000. That's what's in ending inventory. So we know that. And we know the cost of goods sold because, once again, it's on the trial balance. So it's going to be on the trial balance here, that 425,000. So we know the cost of goods sold in foreign currency. So then if we were to back into that beginning balance, just if the beginning balance is what we didn't know, so we're saying we didn't know, we still don't have this number and we don't know what this number is yet. If we were to back into that and we knew the cost of goods sold, we'd say, all right, the cost of goods sold, 425,000 plus the 281,000 is going to be that 706. This is going to be the goods available for sale. So then we would get to the goods available for sale here. And then we know that this plus this is the goods available for sale. Therefore, the 706,000 minus the 430,000 would back us back into the beginning inventory of the 276,000, which was the unknown. So instead of rewriting the formula, I would just write it the same way in vertical fashion and then back into the beginning inventory that we need. Okay, or you could do it algebraically, whatever you think you need to do on that way. But I find that a lot of people start thinking they got to write different equations out when they look at. And okay, anyway, so now that we have these components, we're going to then multiply them times the applicable rates. So the beginning inventory, we're using that 0.18 because that's the rate at the beginning of the time period and or the purchase of P. So 0.18. It's the same for the end of last year and the beginning of this year, 0.18. And that's going to give us the 49,680. But then the purchases, we're multiplying it times the 0.2 because the purchases happen like throughout the entire year. So we should use like an average, the representative number. And that's going to be the 0.2. So that's going to give us the 86,000. So we're using these different rates again, which is going to kind of mess things up to some degree. In other words, we couldn't simply just take the cost of goods sold and multiply it times a rate if we're going to try to basically apply out these different rates to the components of the cost of goods sold formula. So then that's going to give us the 135,680. And then we have the ending inventory. And the ending inventory, we're going to use the rate at the end of the time period. And the rate at the end of the time period, the ending inventory, we're using the rate that the ending inventory was purchased on, which was 1215 right here, the 1215. So we're valuing that like in the historical cost the same way we did up here on the trial balance. And that's going to give us that 57,605 as it did with the trial balance up here. So then if we do our calculation in dollars, then we're going to say the 49,680 plus the 86,000 is the 135,680 minus the ending inventory of 57,605 gives us the 78,75. That 78,75 then is how we got this number. So this cost of goods sold, we had to break out the actual formula and then use the exchange rates that are applicable for each formula. So we couldn't just apply an exchange rate here. If we did so, there's no exchange rate that would match this number because you can see we use different exchange rates within the formula. So that's why it's red. And so there's the 78.75. So that's going to be our complete remeasurement process. Remember, it's a little bit different than the translation, which we saw in a prior presentation. Okay, so now let's go to the differential, and we'll think about the differential, calculating the differential at the beginning when the purchase took place. So we have the investment cost. That's how much the parent put in for the purchase of the common stock, which was $155,000. No tricky business there. It was cash that was paid. So that is what it is. Now, the book value, on the other hand, was given to us in foreign currency. So that's going to be the book value at the point in time that the purchase took place, assets minus liability or equity section of the subsidiary, $700,000 in the foreign currency. We're going to have to then use an exchange rate, and that exchange rate is going to be the 0.18, because that's the rate on 11x4 when the parent company purchased the subsidiary. So the 700,000 times the 0.18 gives us the book value of the net assets, which is going to be the 126,000 now in the US dollar. The difference of the 155,000 that was paid and the 126,000 now is the differential of 29,000. We're going to apply that differential to the depreciable assets, which they said was 20,000 higher in terms of dollars. So they gave it to us in dollars, 20,000 higher. And then the rest of it, they told us was going not to goodwill, but to a patent. So the 29,000 minus the 20,000 means there's 9,000 left of the differential. It's going to a patent. So we're going to have to then put that's the 9,000. Now we have we have a depreciable asset and a patent, which is amortizable. And so we're going to have to deal with both depreciation and amortization related to the depreciable asset and patent, respectively. Now we're gonna skip down a little bit because I want to go to the consolidated net income. So we'll calculate the consolidated net income now for P. So P's consolidated net income. So we're gonna start off with the P's income excluding income from S. This is going to be given to us in the data. So it was given to us down here. This is going to be the parent company's income, net income. The $237,000. That's a straightforward number because the parent company's books are going to be in dollars. Then we're going to add to it the income from S. Now the income from S was in foreign currency. As we could see here, it was in foreign currency. This is the trial balance. This is what it was in foreign currency. We then remeasured it to the dollar, which is now the 39,315. So we're going to be taking that 39,315. That's going to include, by the way, the remeasurement loss here. So it's the sales minus cost of goods sold, operating expenses, depreciation, and remeasurement loss, 39,315. That's revenue, not a loss. So we have that. Then we're going to say minus the adjustment for the differential. Now the differential was related to the depreciation and the amortization. Now this is more straightforward with the remeasurement because we could just simply do what we've seen basically in the past. We have these two amounts, the depreciable asset at 20,000. So now we're gonna have to deal with the depreciation related to that added 20,000, and we're just gonna carry that over 10 years. So we're gonna say 20,000 divided by 10 is gonna be 2,000 for the depreciable asset, and then we've got 9,000 for the patent divided by 5 is the useful life there, divided by 5, so the amortization is gonna be the 1,800. So if we scroll on down there, we got the minus the 2,000 and the 1,800 for the depreciation and the amortization. That's going to give us the consolidated net income then. If we take this number plus this, minus this, that's going to give us the 272,515, the consolidated net income. Now that we have that, we're going to go back up to the consolidated stockholders equity. So the consolidated stockholders equity, we got P stockholders equity at the beginning. This is given to us. This is in dollars because it's the parent company. It's $3,600,000. Then we're going to be taking the consolidated net income, which we just calculated down below, 272,515, 272,515. And then we have less the dividends declared by P, the parent company, again in dollars, which is going to be the 130,000. And that's going to give us then the consolidated stockholders equity at the end. If we were to add this up or add and subtract, 3,600,000 plus the 272,515 minus the 130,000 is the 3,742,515. So now we're going to go down and take a look at the equity journal entries that the parent company would be recording to record their investment in the subsidiary companies. So we're gonna be recording these transactions using the fully adjusted equity method. So equity method. So we're gonna have then the standard starting point is gonna be the investment account. Putting the investment account on the books. This is gonna be straightforward. Nothing new here. Nothing strange, nothing unusual. We're going to say that they paid the 155,000, and so that's going to be investment going up by that 155, and then the other side being to cash. So that one's going to be a straightforward transaction. Then we have the dividends, which also is somewhat straightforward. Now that we have done the calculation, we have the dividends from the subsidiary. This was the dividends in foreign currency, which we have now remeasured to the 9880. So to the 9880. So we may have gotten the dividends. We're the parent company. We own 100% now. And so we might have gotten the dividends in foreign currency. If we got them in foreign currency, then we would debit the foreign currency in units. We'd say, hey, look, we got foreign currency units. And then we would still have to revalue them, however, at the 9,888 or the 9880. Or we might have exchanged them for cash once we receive them, possibly resulting in a gain or loss at that point. But either way, we would record it either as cash or as foreign currency units at that point in time. I'm going to record it as cash here, so we're going to debit cash in the dollars, the US dollars measuring in dollars. So 9880 debit, and we're going to credit the investment for the 9880. Next, we typically take in the equity method the net income, our portion of the net income. We own 100% at this point. So we've got the 39,315. That includes the remeasurement now. So this is the remeasurement loss. So the 153,000 minus the 7875 minus the 24,800 minus the 9360 minus the 1450 is the 39,315, which we would now include here. So the investment then going up by the 35,315 and income from S going up by the 39,315. And then we have the two like transactions which are related to the differential, that the depreciation and amortization, which we calculated up top. You could put these together. Many times people will put them together. I kind of like breaking them out so you could see the differential, the two components of it. So we have the depreciation, amortization, the 2,000, the 1,800. So straightforward here. We got the income from S, debit 2,000, and the investment in S, the 2,000 for the depreciation, and then the amortization, same thing, income from S, debit, investment in S, credit for the amortization.